I know we'll have a bunch of people watching this episode that are going to just kick themselves in the butt because they're like, man, during 2020, 2021 rates, all they had to do was do a VA IRRRL and not have to go through all the hassle or whatever and drop their interest rate 3, 4, 5 points or whatever. That would be crazy.
Folks are waiting for interest rates to come down before they purchase the home. The VA IRRRL requirement have to recoup the cost of the loan within 36 months or less, or we can't even write the loan.
Yeah, based on your current payment, if you kept doing that, you're going to cut 8 years off your loan and you're paying whatever it is, $36,000 in interest times 8 years. So this loan, if you did that, is going to save you $100,000+ in interest over 8 years sooner.
And it's astronomical and so eye-opening when we actually go over those numbers because they don't ever think about that, right? So that is a huge savings.
Yeah.
It's usually jaw-dropping.
Is there any situation that you would advise not to do this? Is there something a time that this doesn't necessarily make sense? Welcome back to the Navy Nuke Network Podcast. Today we're covering one of the most underutilized tools in the VA loan world, the Interest Rate Reduction Refinance Loan, or IRRRL for short, also known as the VA Streamline. This program can help you lower your monthly payment, reduce your interest rate, or if you set it up right, even cut years off of your loan. And it's streamlined, which means no income verification, no appraisal, and a much simpler process than traditional refinance. I'm joined once again by Marcus Stowe and Jonathan McIntosh. If you've been following along, you know that this is one of multiple episodes that we've done together. They partner with Allegiant Vets and spend every week talking with hundreds of transitioning service members, educating them on VA loans and how to get the most out of their benefits. In this episode, we're breaking down exactly how the IRRRL works, the value it can bring, and how to read a rate sheet so you can actually understand what lenders are showing you. Let's get into it. Hello, everybody. I am here again with Marcus and Jonathan. We're going to talk to you about something that's very, very useful. It's a huge tool that we can use as military veterans called the Interest Rate Reduction Refinance Loan, or the VA IRRRL. This episode is going to be packed with lots of tools, lots of tips and tricks you use with the VA IRRRL, and Marcus and Jonathan are going to guide us through that. Thanks for coming on the podcast, Marcus, Jonathan. So,
Thanks for having us.
Yeah, of course, man. The VA IRRRL. What is it, and why do we want to talk about it today?
Yeah, I'll let Marcus kind of go over what it is, and then I'll go over some information on selecting a rate, why you should do one rate over the other, especially with the environment that we're in. It's September of 25 right now, and rates have just finally started to crack and come down. So I'll let Marcus kind of go over the requirements of it, and then we'll go over selecting a rate and making a good decision there.
Yeah, obviously, just like Justin said, he nailed it, which is always a tongue twister. The VA Interest Rate Reduction Refinance Loan, or VA IRRRL for short.
It is a mouthful.
It is.
Yeah.
I always describe it as a security blanket for veterans to ensure that you're really always in the lowest interest rate, the best loan terms, to make sure that, one, you're paying the least amount of interest over the life of the loan, and also giving yourself the lowest monthly payment as well. It's a huge benefit that not every loan products have, like a conventional loan. And it's really designed to ensure that your loan is keeping up with where the market's at. And the VA does recognize that the market changes. And so it gives us that ability to take advantage of that when the market presents itself. The VA IRRRL, it's something that we can do to kind of keep it simple. We can do it as often as possible as the market dictates. The VA does put a seasoning guideline. So essentially, we can look at options 180 days after your first payment. Works out to be around, once you've made your sixth payment, is right around then. We can look at locking in an interest rate 180 days after your first payment, and we can close 30 days later, as soon as 210 days. If you've already met that seasoning guideline and we get to a point where we can lock in a lower interest rate, typically these loans close within just a couple of weeks. So they're very fast, streamlined processes. The whole point is to lower that interest rate. They don't require any income verification, which is awesome. And it doesn't require an appraisal, which is, again, a huge benefit for veterans, where even if you're underwater on the home, we can still take advantage of the lower market and the lower interest rates because no appraisal is required. So again,
Nice.
that's really that security blanket where if in a standard conventional loan, where if you purchase a home, maybe you don't put very much down and the market shifts and your home is worth now less than what you owe. On a conventional loan, you can't refinance to a lower rate. You're
Or
stuck
you're
in what you have.
or you're coming in with a ton of cash to refinance. So that's what's happened. Unfortunately, recently I've seen a few loans where they bought a house a year ago and it's maybe worth 10,000 less because there's a couple bad comps, and they're coming in with $10,000-$20,000 in order to refinance, which they need to because they're at higher interest rates. So you just don't have to worry about that. So
Yep.
So to recap real quick, the seasoning period which you're talking about, that is important to know because say like in my scenario, in my specific scenario, for those of you who don't know, I am utilizing Marcus and Jonathan for my new house that I'm buying. It's possible that the interest rates could go down after I close on my house next month. So for somebody like me that's buying a house, we can have kind of ease of mind knowing that if the market does go down, that in that seasoning period, that 6 months, I could lock in a new interest rate as long as it meets the guidelines that we're talking about here in a minute. But that means that I could swap from my current interest rate in VA loan, down to a lower interest rate as soon as I'm done with my like 6th payment around there, and get to where I have a lower monthly payment. That's what we're talking about. But if somebody's already
Exactly.
like have an established VA loan, they've been there, 6 months or longer, 10 years or whatever, they can still do the same thing. There's not a limit on that, right?
Yeah, exactly. Yeah, and it's amazing how many, clients I know, John and I both had those conversations with folks and veterans where they've owned their home for 3 or 4 years and have never taken advantage of the VA IRRRL. They just didn't know about it or thought you could maybe only do it one time or there's some kind of limitations. But it's amazing how many folks have, will stay in their current mortgage terms and interest rate without knowing that they could take advantage of that VA IRRRL. And we definitely saw that in a few occasions during COVID where we had very low interest rates, and some folks didn't take advantage of that. So it's super important to know that tool is in your belt to take advantage and making sure that you're not just paying too much, interest over the life of the loan.
I know we'll have a bunch of people watching this episode that are going to just kick themselves in the butt because there's like, man, during 2020, 2021 rates, all they had to do was do a VA IRRRL and not have to go through all the hassle and whatever and drop their interest rate, 3, 4, 5 points or whatever. That would be crazy.
And I think in this day and age right now too, a lot of first time buyers or folks that maybe have owned a home in the past, but maybe have sold, but they're in a position right now. And John and I, we've seen this a lot where folks are waiting for interest rates to come down before they purchase the home. Well, with the VA IRRRL, you don't have to worry about that. You can get into the home, find the home that you want. And as you said, have that, peace of mind that if the market does shift, 6 payments, 180 days after you close, you can take advantage and get into a lower interest rate. So, as we often say, you can always renegotiate the rate, can't renegotiate the purchase price. So get into a home now and take advantage of the VA IRRRL when the rates dip in the future. So I always say to folks, this is not going to be your forever mortgage. And you're going to be able to utilize that program to lower that interest rate and payment when the market does shift, down the road. And generally speaking, now we are starting to see a lot of positive movements in the market right now. So getting into a home right now and then being able to take advantage of that, down the road that's a huge benefit.
Yeah, of course. And what is the eligibility in order to get to the new rate? Doesn't it have to like drop a certain amount from like where you're at in order to take advantage of it? Like, can we talk about that a little more?
Mm-hmm. Absolutely. Good question. So kind of keeping it basic is that whatever interest rate that you lock in, when the market does shift and you meet that seasoning guideline, interest rate needs to be just at least 0.5% lower than where you're currently at right now. There's a few other guidelines on top of that, but let's just say, today you lock in a 6% interest rate. In that 180 days after your first payment, as long as rates are at least at 5.5% or lower, then that's going to open up that option to take advantage of the VA IRRRL.
Okay, so like rule of thumb, about 0.5% lower than where you are now.
Correct.
Yeah. It's going to depend on loan amount too. I mean, if you have a very small loan amount, like 150,000 or lower, there is fixed costs involved, like title fees, and depending on what state you're in, you might even have attorney fees, which are even more expensive than title most of the time. So it depends on what your loan amount is, as to whether or not it makes sense at 0.5%. I'm in California. Marcus is in Phoenix. There's, Scottsdale, Arizona is pretty expensive. A lot of California is pretty expensive. We're seeing loan amounts that are 5, 6, 700,000. Those loan amounts, make a lot more sense at 0.5% reduction. A lot of clients, I have a client I talked to yesterday we can get her down 0.5%, but her loan is only like 380, and it doesn't, it makes sense, but we don't think we're at the bottom of where rates are going to get. So in her particular instance, we decided, hey, let's wait and see what happens. She's not at a super high rate. She's at a 6 and an 8. We can get her down to 5.625, but she wants to wait and see if it gets closer to 5.25 or 5%. So a lot of factors go into whether or not it makes sense to do it at the time. Definitely if you're at a $500,000, $600,000, $700,000 loan amount, 0.5% in interest drop, if you do the math on it, is quite a bit over time. And the recoup time is much shorter. So there's a lot of factors that go into it, but yes, that is the requirement minimum per the VA. We have to go down by 0.5%. Unless we're taking you out of an adjustable rate mortgage, which probably 90% of people are not in, because the VA adjustable rate mortgages were not very competitive for like the last 6 years. And most loans in the country are, between 5 and 7 years old, like 80% of them. So there's very few people in that scenario, but that would be the exception. If you're in an ARM and you want to get into a 30-year fix, we don't have to meet that 0.5% requirement.
Okay. And we do. So I just want to make sure that I do say this. I don't know if I specifically said it or not. You must have a current VA loan in order for this to happen. Like you can't do a conventional and be like, well, I am a veteran, Navy veteran, whatever, and I do what we're talking about. It must be a VA loan that you already have currently.
Exactly. Yeah,
that's correct.
And the two things that kill most refinances is low appraised value, or their income doesn't qualify for some reason. Maybe they switched careers and they're a realtor now and they were on salary before, or they have commission income and their commission went down. So those are the two things that kill the majority of loans. And on the VA IRRRL, like Marcus already mentioned, those two things are completely out of play since we're not going to verify income. And we used to have to verify that you had a job, just not how much you were making. And now we don't even have to do that. So we literally delete your employment altogether on the application. And then same thing with the value. If you bought your house a year ago in a market that was kind of high, and now it's worth a little bit less, doesn't matter. It's still going to be fine.
And that's one of the things I like most about this, is that the barrier to entry is like super minimal.
Yeah.
Right. And
it's
like in the case of somebody that decides to become self-employed, or they're trying to get their life going in another direction and do end up either taking a pay cut, which I hope our Navy Nuke friends on the viewers of this particular episode, I hope they don't have to take less money than they are right now. But in the case that they are trying to switch things up, that's something that can kind of keep them have peace of mind in that decision, so that they know that they have options to even spend less money per month without having to go through that hassle, especially if they don't have other, like a spouse or anything with other income.
Yeah, at the end of the day, life happens and things change, and a new job comes along, or God forbid you lose your job. That
or you, Marcus.
Great example
right now, perfect example. Marcus worked for Rocket Mortgage as an employee last year, and since last fall he's been working with me. So he's basically, he has to wait until he files his tax return this year in order to qualify on a conventional loan. Or even if rates were lower than his current rate, he couldn't refi until he has qualifying income. So it's a pretty massive benefit that people don't really realize until they're in the situation where they can't refi. That'd be the only time you might really realize that. But it is a major problem for a lot of people who want to get into a lower rate and they're stuck at a higher rate because they just can't qualify for the loan that they're going to go into. So
right. And let's if you don't mind kind of explaining how the market has gone. We talked about it has kind of gone down, but over the last 5 years, it's been kind of a roller coaster of
Yeah.
real estate emotions as far as the interest rates go. So from then to now, like what's it looking like? Is there a steady? Is it more steady, or is it still like volatile? What are we looking at now?
I would say it's more steady than it was
Yeah.
a
Even
year
from a month
ago.
ago.
I still have kind of PTSD about it because it's been very violent for the last 3 years, I would say, where we would get like a little window of hope that rates are going to go down and then boom, right back up. So I still don't fully trust it yet. Based on what we're looking at, it appears that we're going to be trending into a stable rate declining market. But, I'm telling everybody like, hey, if it makes sense right now and you lock and you close and it goes lower, then okay. I mean, it's like trying to time the stock market for the last 3 years. It's like trying to catch the lowest rate that's going to be available is like trying to catch a falling knife. During COVID, it was very stably going down. And then in the last 3 years, it's been basically between 6.5 and 7, 90% of the time. And we've had very small windows of opportunity. Like last September, one of the guys that worked for Allegiant Vets, I actually, last September, got him a 5.25 because we had that for like 10 days and then it was gone. And then it went all the way up to like almost 7 for the last year. And I mean, I do presentations every week with Allegiant Vets where Justin and I met. And on one of my presentations, I go over what current interest rates are. And it was basically just, I was adjusting it from 6.5, 6.25, 6.5, 6.75, 6.25. Like it was in that band for, it was getting boring to talk about because it was like there was basically, hey, sorry, there's basically no change. This is the first time in like at least a year, probably more like 2.5 years, where we've actually seen rates stay, at or around or below 6 for a sustained period of time longer than like 2 weeks. So it's really been very stagnant for a long time. The longest in my career, I've been doing this for 15 years, and I've never seen it stay in such a small box for such a long period of time. And so I think, based on what's happening now, I don't want to jinx it, and I don't fully trust it yet, but I think we're moving in the right direction rate wise, and I think the trend is going to be down over the next 18 months. So
okay, cool.
Just when the bottom is, nobody knows.
I'm sure y'all have got a bit of a spoiled clientele from COVID times where they actually saw such low interest rates. Now, like, oh, interest rates are so high now.
Yeah.
I mean, relatively, yes, they are high, but I mean, like, it could be way worse.
Yeah, historically, they're still not high, but then the argument is, well, home prices are high, which is also true. But yes, people didn't want to do anything. Like 23 was the worst year in my career as far as how many transactions and people that we worked with. I mean, it was like 20% of 22. It was like just off the cliff. So people are starting to get impatient. Their families have grown. Maybe they're making more money. We are seeing the patience wear off on people where they're like, okay, I've been in a 1,200 square foot house because I got married and I didn't have any kids. Then I had one kid. Now I have 3 kids and I'm bursting at the seams. And I have to move now. So we're starting to see a lot of people going, hopefully rates come down, but I have to move because this is just not meeting my needs anymore and I can't put it off any longer. So we're seeing in the last 2 weeks a lot more buying activity than we've seen probably in the last 10 months. I mean, we're working on 3 to 5 new transactions a week right now. And that was like, that's probably double what we were doing for the last year. With rates ticking down a little bit and then people just getting to the place where they're just like, I can't wait or hold off any longer and hope that, rates come down. I have to do something.
Yeah.
Yeah. And I would say that's exactly right. I mean, we don't know what the future holds. We don't have a crystal ball, but that is the huge point of the VA IRRRL is to be able to have that in your back pocket when we do see these shifts in the market. And that always is the case. Like John said, we've both been doing this a long time, even in normal markets. And I would say it's not a normal market still from COVID on. Even before COVID, markets went up, they went down, and so that's what that VA IRRRL is designed to do is take advantage of, of those shifts and those dips, and put you in a better position when that time comes.
Now, y'all have and this is something I know you talk about in the Allegiant Vets presentations, but you have like a watch where you can kind of sign up for when it dips, you know that you're in a window, right? So that can kind of be running in the background without you always having to check, right?
Yeah, and if any of you have made the mistake of going on like, Lending Tree or Bankrate and putting in your phone number and email, you've found out real quick that, they sell that information to like 80 mortgage companies and they're going to call you every 5 minutes for about 2 weeks. So if you want to avoid all that, we have a VA rate watch list that Justin has the link to. And if you guys want to jump on there, we're not going to even call you when you put your information on there. We're only going to call you, once the rates are in a position where, hey, you're at least 0.5% below what you stated your current interest rate is on the form on there. So yeah, if you want to not get bombarded, and you want to just get informed whenever the rates are 0.5% lower than where you are, feel free to jump on there. And then Marcus and I check that list every week, and we'll send out emails or texts and say, hey, you filled out the form. Looks like you're at 6.5. Rates are at 5.99 or 5.75, whatever they are. And let us know if you want to have an appointment to kind of go over if it makes sense to do this right now or continue to have us monitor it for you.
And I'd say, in addition to that, it's always nice to have, a mortgage guy, just like you have a car guy or, you have a doctor, we really like yeah, insurance. It really does make sense to have somebody that you trust, have a point of contact. And we've, John and I have built relationships obviously for as long as we've been doing this that, we definitely, I recommend them, my clients as well, don't just wait necessarily. You don't have to wait to, for me to reach out. Feel free to, drop us a text, like John mentioned, like everybody's situation is a little different. Loan amounts are a little bit different. And I actually just had somebody touch base with me and, they're in South Dakota and their loan amount was a bit smaller. They owed about $215,000. And it was a similar type situation where they had a rate in the low sixes and we could get them maybe into drop that 0.5%, but it just didn't quite, make sense right now. We need a little more dip. So that's one thing that John and I, we always shoot people straight. And it's, it's nice when somebody reaches out to us, hey, does it make sense now? Maybe not. Take 2 pills, call us in the morning and, we'll, revisit it down the road a little bit.
Yeah. And that kind of leads me into the one of the big things I do want to cover for this is costs. I know people are probably having that in the back of their mind so far. What costs are associated with doing this?
Yeah, pretty minimal. When we can, we use a company called Atlas Title. They're actually local to me. They have only 2 offices, one in Orange County, one in Roseville, California, which is about 10 minutes from here. And so the reason why their cost is so much less than like a First American or Fidelity or Chicago or Lawyers Title, like things that people have heard of, is because they only have those 2 offices. And so they're generally about 30 to 40% less expensive than those other legacy brands that everybody's heard of. So, and they're in almost every single state. There's a couple states they're not, and then there's a couple states in the East Coast, especially that are what are called attorney states, where you actually have to have a closing attorney review your documents with you and do the signing. So, those states are going to be more expensive. Like New York is like, what is it, Marcus? Like $10,000 to refi no matter what. Pretty
expensive.
Much.
Yeah, you've got some states like Illinois and North Carolina. Those are attorney states. And unfortunately, we just don't have control over that. And that's the bulk of the cost on that is title and attorney. But, but I'm actually helping somebody in New Jersey right now, where their costs are a little bit higher as well. But we've structured it such where we've got a lender credit that's pretty much wiping out their title costs, all that. So that leaves in with no appraisal. That wipes out that $600 or $700, and
then underwriting with most of our banks. All the banks that we go through have, every bank pretty much either has an origination or an underwriting fee, or a lot of banks try and charge both, which I've gone over, I think, in previous episodes about the origination fee. Is basically a junk fee. A lot of our banks right now, because we're entering like a VA IRRRL season, they've either eliminated or significantly reduced their underwriting fee. Rocket's one of our primary partners. Their underwriting fee was $1,000, and then they were like, "That's too high. We shouldn't be charging veterans that much." So they 2 weeks ago decided to lower that to $495, and as far as I know, that's one of the lowest out there
on the streamlines.
Yeah, on the Streamline product only. So thanks for correcting me there, Marcus. Yeah. So on the Streamline product, $495, and then you have recording fees, which are usually around $100. So title, if you're in a title state, is going to vary on the state, but California, it's about, on average, I would say it's $1,200 through Atlas. It's probably $2,000 through First American or Fidelity. And then there's, little tiny things like that have to do with title, mostly $25 tax stamp and, tiny stuff. So you're looking, I would say, on average on a Streamline, hard fixed costs are anywhere between $2,500 and $3,000. But like Marcus just mentioned, we're also starting to see lender credits become available where the lender is saying, hey, we'll give you $3,000 to cover the closing costs to help make this loan make more sense for the veteran than if we didn't have that. But the lender credits are based on the loan amount. So that's why when you have a smaller loan amount, you have a smaller lender credit. And those fixed costs like title and attorney fees, those do go down if the loan amount is smaller, but not by that much.
Yeah.
I mean, it's like, okay, instead of $1,200 on a $500,000 loan, it's $1,000 on a $100,000 loan. It's not like, half as expensive or 20% as expensive. So, but yeah, generally speaking, the fixed costs in most cases are going to be like $2,500 to $3,000. And then if we can get credits from the bank to cover that, you may end up with zero cost. And I know a lot of people will be like, oh, I've never paid closing costs on a VA loan. Absolutely true. And I'm going to get into pricing in a little bit here and kind of explain to you and show you why that's the case and why taking a zero closing cost loan may not make the most sense, actually. It may be a worse financial decision depending on how long you're going to be in the home, et cetera.
I thought that there might be some costs. I thought it was going to be a lot more money than that to do something like this. So I'm pleasantly surprised. Just a few $1,000s isn't that big of a burden when we're talking about the savings you can have over time. So that's cool, and especially if you can get the lender credits to kind of knock it out, that would be super clutch if you're doing it.
Yeah. It makes it easy for us when we say, hey, going to save you $200 a month and it's free. So,
right. Now, is there any situation that you would advise not to do this? Is there a time that this doesn't necessarily make sense?
Yeah. I mean, Marcus, chime in here too. I would say, especially at this point in time where we don't know what's going to happen with rates, I would say if it's longer than probably a 36-month to 50-month recoup time on the cost of doing it, you may end up with another opportunity to do a VA Streamline. So it may not make sense in that case to do it if you're looking at like a 5-year break-even period.
And by that, you're meaning by the couple $1,000s that you're spending, if that is,
right.
If it takes you that long in order to save that much money off of your lower,
Yeah, like if you're saving $200 a month by doing it and the costs are, let's say they're $3,000. So divide 3,000 by 200, you're looking at 215 months. So that's pretty short. You're looking at, hey, if you're not in that loan for longer than 6 months, well, you didn't really waste that much money because, like I said, it's really hard to time it exactly right. So yeah, I mean, most of the time when we're doing these, we're looking at between I would say a 1 to 2.5 year recoup time is probably the average.
Right.
The bigger your loan amount is, then a lot of times the shorter your recoup time is because your monthly savings is more significant and the costs do not vary a whole lot. What do you think about that, Marcus? Anything to add there?
Yeah, and I was just going to add to just kind of a side note, John. I don't know if we want to go back. The VA IRRRLs, if you remember, the VA IRRRLs, and this is why I don't always like to get too complicated on this because I don't like to confuse people, but the VA IRRRL requirement is that we have to recoup the cost of the loan within 36 months or less, or we can't even write the loan.
Yeah.
So the monthly
I just
savings,
haven't run into that in so long.
We don't get that very often. And but yeah, the VA IRRRL requirements is the 0.5% rate drop, and the costs have to be recouped within 36 months, right? So if your monthly savings is $300 a month, then the cost of the loan, well, that's pretty big savings, but $300 a month times 36 months is $10,800, which that's a lot. So, But that comes more into play when we see those smaller loan amounts, like John was mentioning earlier, where it doesn't always make sense when we get to the smaller the loan amount, because some of those things are fixed cost. We may not be able to recoup that within 36 months, but those are rare exceptions, especially in this day and age where property, with loan amounts are, where they're at. But yeah, even just this example of the client that I'm helping in New Jersey right now, with the lender credit I have, he's saving about $380 a month. His recoup time is just going to be a couple of months because we've covered the majority of that cost, and so now the savings are there, and so he's in a really good position. Even if rates were to dip in another 6 months, he can take advantage of that.
We keep talking. You keep using the term streamline. That's interchangeable with IRRRL, or no?
Yeah, sorry. Yeah, that's on our side of things. Like when we price a loan, we select a VA. We select a VA Streamline. So sorry. Yeah, that's the same. One and the same. IRRRL and VA Streamline, VA are all the same thing.
We call them the same. Yeah, VA Streamline, VA IRRRL. It's kind of just the lingo that we refer it to. As a streamline refinance, no income, no appraisal. It's a streamline process. Good question.
Like when you're talking about refinancing, just in general. Like we were talking about, like with a time where you may not want to do this, or like the negative side of refinancing, just to make sure people are thinking about everything, would I guess be just the change of your loan term back to like 30 years or whatever, right? So I mean that's something you always have to juggle to see like if that's worth it or not. But like you mentioned earlier, Jonathan, like the average loan age, somewhere between 3 to 5 years. Somewhere like that.
Right. No matter what's happening, I mean, right now we're seeing some older loans because rates got to the lowest point ever. But even still, there's a lot of people that did 2.5%, 3% loans that had to move, got divorced, needed cash out. I mean, so there's a ton of people. I mean, Marcus, when he was at Rocket, he was only doing basically cash out refi for the last part of his time there. So he was taking people out of 3% loans every day that, for whatever reason, life events had happened that required them to do that. So, it's kind of amazing. No matter what is happening, the average person only stays in their loan for 3 to 5 years.
And I would say one of the things that you have that's a really normal question or even normal concern is saying, hey, I've been in this loan for, a year or 2 years or 3 years, and now I'm going to do the VA IRRRL and go back to a 30-year. Really two things with that. One, especially as the market continues to shift down, we're going to see more opportunities where we can shorten the term with the VA IRRRL and lower the interest rate, and so be able to help pay their home off sooner. And that potentially will give them still monthly savings and shorten the term, or we might keep their payment relatively about where it's at right now and still be able to shorten that term out, taking from a 30 down to a 20 or a 15-year term. And that certainly presents itself, but also we go over those options as hey, we're saving. Like, for example, my recent client where we're going to save them about $380 a month. Now, they've only been in this loan for just about a year. Sure, you're resetting the clock back a year, but one of the things that you can do is it's up to you. That monthly savings is going to be flexibility. It's still real savings. Whether you take that $380, put it in the savings account, which everybody can use a little bit larger of a savings, or you can take that $380 and apply that right back towards your principal and make the same payment that you are making today and shorten your term. And that $380 right back towards the principal, probably on a 30-year mortgage, would shave them down to a 22-year term and shave, 7 or 8 years off the loan, saving hundreds of thousands of dollars over the life of their loan. So that's something that, we try to break down with them and saying, hey, this is your option. It's your mortgage. Take that $380. It's going to give you a lot of flexibility month to month. Or you want to continue to pay down that because you have a particular goal in mind, maybe when you're looking to retire, pay the home off by a certain time, or, hey, I know I'm going to sell this home in 5 years. I want to pay down the principal so I walk away with a little bit more equity in the future. Then apply that savings right back towards your principal. And we can break that down for you and say, hey, if you do that, this is how quickly you're going to pay your home off and how much interest you're going to save over the life of the loan. And it's astronomical and so eye-opening when we actually go over those numbers because they don't ever think about that, right? So, but that is a huge savings. It's massive. It's usually jaw dropping.
Yeah. Yeah, I was just going to say, like, whenever, that we get that question a lot, oh, I've been in my loan for 15 months. So going back to a 30, am I just wasting all that money I just paid down on my, balance? Which, for one, interest is front loaded. So on a 30-year loan, what percent of your payment is going towards your balance versus interest is much higher in the beginning. About midway through your loan, like when you have 15 or so years left, is when it starts getting pretty close to 50-50. Half's going into interest, half's going to your actual loan balance. So that's the first thing on that. And then also, like Marcus said, the term only dictates the maximum amount of time that you have to pay off the loan. It doesn't. So if you say, hey, if you just pretend you didn't refi, let's say we're saving you $300 a month, and you just pretend that you didn't refinance, and you just kept making the same payment that you have now, like Marcus said, and in a lot of cases that might be taking 7, 8, 9 years off of your loan if you just kept making the same payment you are currently. So as far as going back to a 30, there's like never a scenario where it doesn't make sense to refi at a lower rate. It just means that, yeah, if your goal is to pay off your house with the least amount of interest, then, and your payment doesn't bother you, then just keep making the same payment. And instead of paying it off in 28 years, maybe you're going to pay it off in 22 or 20 years. And we can do the math for you very quickly and tell you, based on your current payment, if you kept doing that, you're going to cut 8 years off your loan and you're paying whatever it is, $36,000 in interest times 8 years. So this loan, if you did that, is going to save you $100,000+ in interest over the time, and you're going to have a free and clear house 8 years sooner.
Actually,
Marcus
I just
probably
went
did
ahead
the
and
math here.
I did actually, because I have a really good
Can't help
tool. So
himself.
yeah, I can, because that's where I always tell clients, I'm like, this is my nerd mortgage math. That's where I get excited about it, because Don and I both know, and we've been doing mortgages a long time, so we know the financial benefits of paying extra or doing biweekly payments. But just in that scenario where we're helping somebody right now today, that $380 in savings would take him from a 30-year mortgage down to a 23.8-year mortgage, saving them $160,103 over the life of the loan. Huge. That is, that's a lot of money that's just sitting on the table, where all they're doing is making the same exact payment that they are today, and they can shave off 6.5, 7 years off the loan.
Absolutely.
Yeah. How many times have we heard that $150 a month is not worth it, Marcus? Too many times.
I'd be rich if I had $1 for every time I heard that comment.
I know. I'm like, so if we came to your house every month with $150, you'd say, "Oh, I'm good. I don't want it." We put it like that, nobody says no, but because they think it's some huge ordeal and difficult process to refi. And really, nowadays with the computers and technology, I mean, it's pretty. It's basically, if you can DocuSign and upload an attachment to an email, that's about as difficult as it is to get yourself, into a lower interest rate.
Right. I mean, it's called Streamline for a reason, right? So.
Yeah, and again, that's what really goes back to your question, Justin, too. Is like, is there times where it doesn't make sense? Sure, absolutely, and that's where John and I have that knowledge in saying, all right, here's what it would look like doing this loan. Here's what it would look like not. Does it make financial sense? And at the end of the day, too, if it really doesn't make sense, we're saying, hey, yeah, it really doesn't make sense. But if it does, and it does make financial sense, we're going to break that down for you. So you can make, I would say, I want to give you those numbers so you can make the best financial decision for you and your family and your mortgage.
Right.
Yeah.
And I mean, the whole reason I even asked that question was because I know that our audience are going to be, a large majority are going to be active duty military, Navy nukes that, they're moving around every 3-4 years. So they're going to have mortgages that are, in that age, or if they're trying to buy a new house, or like they're moving soon, whatever. Those are just things that can, take in consideration. And definitely when you talk about over the lifetime of a loan, how much you can save, that's obviously, there comes great value in that. But
there's even an additional, one thing I was like you said, over the life of the loan, but we don't even think about the impact within the first 5 years. That scenario, they actually build a ton of equity in their home by an additional $71,000 within the first 5 years of that loan.
Absolutely. And for those people that are, in that they're just a few years in, if they even just want to get back to back to even, they don't have to think of it as like the lifetime loan. They could be like, oh, well, it's just going to take me, 11 months to get myself back to where I was in the beginning. And then I can, pocket the $150 a month or $300 or whatever it is, so that, family members, spouses, whoever out there that's probably that aren't as informed, it'll be like, what's the point? Why are we doing this? Like, we're just but that kind of gives them peace of mind.
It's usually an uncle or, grandpa. Oh no, if you're not going down by at least 2%, it's not worth it. It's like, well, yes, back in the 60s, of course, and when loans were 60 grand and it cost $2,000 to $3,000 to refinance them, then that was absolutely true. Rates had to go down by 2 or 3% for it to make sense. But nowadays with the loan amounts, it's like, I can show you 100 different ways it doesn't need to go down by a full percentage point for you to save a significant amount depending on your loan size.
All right. So Jonathan, I know you have some more things we need to go into, but first I know Marcus, he's short on time. It's okay. We're going to let him go do his thing. He's got a life too. So Marcus,
couple of kids.
Feel free, feel free to go do what you need to do, man. I really appreciate you coming on.
I appreciate the opportunity, and we'll talk to you guys soon.
All right, man.
All
Thanks.
right. Later, Marcus. So I just wanted to kind of get into, kind of I feel like man behind the curtain and explain, because what a lot of people, you talk to a mortgage person, they tell you, hey, here's the rate. Okay. Or people call all the time, hey, what's the rate right now? Well, there is no rate right now. So that's what I kind of wanted to get into, is kind of show you guys what we look at and understand why we choose one rate over another. So I'll get right into that unless you have anything else before I do, Justin.
I'm well versed in this because, again, like I mentioned before, I am going through the process of buying a new home, and I'm using Jonathan and Marcus, and I've had to look at these charts on what he's about to show us. So I've actually been able to see it before. So let's look at it.
All right. So this is just one of our investors or banks. We have a bunch of different ones. So this is just one of the ones that we use quite a bit. So this is a rate sheet from today. This is the lowest rate available, is 4.75. So this, I put in a $600,000 loan amount just because that's, to kind of illustrate a larger loan amount and kind of show you guys better what the credits look like. So what this column is here is points. So a lot of you probably have heard of points and don't may or may not understand what does that mean. So if you wanted to get a 4.75% today on a VA loan, it would come with 3.868 points, which points mean percent to make it simple. That took me a long time when I got into mortgage to grasp what does that mean. So if you take 600,000 times 3.868%, you get this number, which is 23,208. So that's what you're paying just for the interest rate. On top of that, you would have title, taxes, insurance, underwriting fee, possibly. So that's why in this next column here is the estimated closing cost. Now that column is not accurate at all. I don't look at that ever. We manually calculate and get all the fees from title or the closing attorney, and we give you a disclosure called the loan estimate that tells you exactly what it's going to be. It's an estimate. However, it's going to get better than that. It's not going to get worse. So that's the lowest rate available, which, that's a lot of money to spend. I did have people in the pandemic that, could have gotten a 2.5, and they said, hey, rates are never going to get this low again. And I had a guy pay $30,000 to get his rate to a 1.75. So there is times where that does make sense to do, especially if you're using your equity. I mean, the guy ended up selling 2 years later. So, it didn't really work out, but, the thought was pure. So as you can see, as we start going up, this is the rate on the left-hand column, by the way. So as we start going up the rate sheet, the price starts reducing pretty dramatically here. There's what we call kind of sweet spots. Look at this. So 5.5 today would cost you 0.653 points, or 0.653% of your loan amount, which is $3,900. Just a eighth better at 5.375 costs you 3,000 extra and basically double in points to get to that low of an interest rate. And as we start getting up here, we start to see some weird stuff. So if you look at this, 5875 costs $1,400, 575 costs $4,500. But then look at this, we have 5625 is only $948. So there is sometimes what we call buckets, and like that's our lingo, is there's a weird rate bucket where for whatever reason, the VA and the secondary markets that are the securitizers of these loans, they want us to promote that particular interest rate, so they give us a significant discount, even though this rate's lower. Like, why would you ever do this when you can get this for $3,000 less? So,
Right.
you know, if we were sitting here today and we said, hey, rates are probably not going to get lower, rather than do a no cost loan or a reduced closing cost loan, like up here, where you start getting an actual credit, like at 6.125 on, if you have a $600,000 loan today, we would give you $4,100 to cover all your closing costs, probably in 80% of the cases, unless you're in an expensive attorney state. Or these two options are basically the same. 5.99 and 6% are basically the same. It's really just a mental thing. People want to see something with a 5 in front of it versus a 6.
Right.
So yeah. I mean, if we thought we were at the bottom, I would tell you, okay, well then, you know, we can roll in the closing cost to your loan, so you can get, you know, a 0.5% better interest rate for a $948 cost, and then you just pay your regular closing costs. Versus if you take this, over time, the interest is going to eliminate the credit you got of $4,100. It's going to eliminate that because you're going to pay more interest than the $4,100 gave you over time. Now, if you're like, hey, I'm only going to be in this house for 2 years and then I'm moving, great, let's do this, because you're not going to save $4,100 over the next 2 years between these two interest rates. Because here's the payments over here. So let's just look at this here. So 38.56 on the 6.125, and this is just principal and interest. So 38.56, which, you know, we don't control your taxes or your insurance. So when we calculate your savings, it's based on the principal and interest. Versus if we did a 6.125, we would be at 36.45. If we did a 5.625, we'd be at 34.53. So that's a $190 difference. So the way we look at that is that costs $948, plus we add up the credit of $4,100, and that's our delta between the two. So plus $4,128. So there's a difference of $5,076 between those two rates, and the lower rate is only saving you $192 a month. No, not only, but that's the difference. So you have to be in that loan for 26.4 months minimum for it to make sense to take the lower interest rate. So, you know, that's
Right.
how you got to look at it is, hey, if you're like, I'm moving next year, don't take the lower interest rate because it sounds better. You know, you got to really, it's all math. I mean, you really just have to look at what you guys are good at math. So that's the good news. We don't have to explain, you know, calculation to you guys, but it's really dependent upon how long you're going to be there. And also if we think this is the bottom. The reason why I'm not super encouraging people, which a lot of people are calling veterans right now going, hey, we can get you down, you know, to like a 5.25, and they're rolling in $11,000 because it's like, whatever, it's just your equity, you know, which, okay, you know, that's true. Equity can be used as a tool to get your monthly overhead to be lower. So if your payment is really stressing you out and that's going to get you to be okay and, you know, not feel like you need to sell your house, then by all means, go ahead and do that. But that is locking you into being in that loan for a pretty long period of time. And actually, like Marcus said, you may not even be able to do that because the 36-month recoup requirement may not permit you to do that anyway. So
that was going to be the
covered
next.
a lot there. So ask me some questions.
No, it's fine. I wanted to just clarify what you just did, but you will be looking at rate sheets on IRRRL as well, not just your first VA loan. So this is something that you'll look at when it comes to figuring out what your interest rate is going to be for your refinance, correct?
Yeah, like today, if we were talking and you're like, hey, I'm not going to move from my house, And we don't know what's going to happen with interest rates. I would say if you're feeling optimistic about interest rates, then, I would probably take this for now. And, if you're feeling optimistic that they're going to go down, I'd say, hey, get most or all of your, mostly all of your costs covered. Or if you're like, hey, we don't know what's going to happen and I really want to be in the mid fives, then I would say probably these are the two options I would tell you to look at. This doesn't make sense, obviously. Like, why would you pay extra for a higher rate? And this is not a big enough difference to me to waive the $1,700 savings on the eighth of a percent higher. So that's how we look at it. That's the conversation that Marcus and I have with people every day is pretty much two options. Here's a short recoup time. Here's a longer recoup time, especially when we're in a declining interest rate market. Now, if we get into the mid fours, I'm probably going to start encouraging people to say, hey, maybe you look at a full, rolling in a point, because you may never be able to get back to that rate if rates get higher than they are now. Which is what we did a lot of that in the pandemic. People, a lot of people knew. They said, hey, I'm never going to move from my house. I'm in my forever home. Rates are not going to be this low. Let's roll in 10 or 15 grand, get my rate as low as possible. And that worked out.
Yeah, in that case, it definitely makes sense. What's the lowest you've ever seen? What was the best deal?
The 175.
A 175.
Yeah, 175 on a 30-year loan. Yeah, VA loan. Yeah, the guy was a veteran and now is a fireman, and bought a beautiful property near me on like 10 acres. Had some cows, and then decided, oh, I need more land for my cows, and sold 2 years later to buy a bigger property. But cost him some money. If he had been there for a couple more years, he would have broken even on what he spent on getting that loan. So if he had been there for longer, it would have made sense. I mean, at some point, whatever you do will make sense. It just, the more you're investing in the loan, then the more time it's going to take to recoup it.
Yeah.
But that's how I like to explain it to people too. It's like, okay, don't look at it as it's just a cost. It's like, okay, if this rate saves you $300 versus the free rate, let's call it, the lender credit rate. If I gave you $300 a month and you gave me $7,000 one time, and I gave you $300 a month for the next 30 years if you don't move, that's a pretty good investment. I mean, people buy rental properties hoping they make $300 in cash flow per month, and they spend $300,000 on that house and have tenants calling them about the toilet and whatever to make $300 of cash flow. So that's how you kind of have to. That's how I like to look at it. Is it's basically an investment. It's, hey, if you're going to be in your house for a long enough period, you're investing. Yeah,
you look at it as an investment, and then you make the numbers make sense. A lot of times, people, in my experience talking to people, a home is a very emotional buy. It can be, and trying to separate the emotions from the numbers can be a little difficult. But if you can kind of keep that in check, you can look at this and like kind of see the pros and cons and go with what's going to make financial sense.
Yeah, and the really cool thing about the IRRRL is they'll let you roll in up to 2 points. So you're not even coming out of pocket for this. If we get to a point where you're like, hey, I think the rates are not getting any lower, you could roll this $11,200 into the loan. So it's not even out of pocket. So you can roll that plus the regular closing costs, plus the funding fee. That's one thing I think we didn't touch on earlier. If you're still in the military or you're not receiving a disability, VA disability, then you will have a 0.5% funding fee. So 0.5% of your loan. So for every $100,000, you have a $500 fee that goes to the VA. If you have a disability rating of any kind, that's waived on every VA loan for the remainder of your life. So that's one thing that will you the cost quite a bit, whether you're receiving VA disability or not.
Right. Yeah, I don't know why. That's one of my questions I had written down. I didn't ask that one, but yeah. So VA disability rating makes it where you don't have to pay the 0.5% funding fee associated with the interest rate reduction for refinance loan.
Yeah, which is still rolled in. That's never out of pocket, but it still is going to add to your loan balance. You're still going to see it. So it's definitely something to consider. And that really determines, especially on smaller loan amounts, that can sometimes skew us to where, hey, no, we need it to go down by another 0.5% because your loan's not that large. So with that funding fee, we need it to go down even more because that's an additional amount we're adding to your loan. And everything that we add to your loan is reducing how much monthly savings you have.
All right, cool. And if I haven't I haven't mentioned it, but Jonathan did mention it earlier. For those of you that haven't maybe seen an episode with Jonathan or Marcus previously, the whole reason I even know who they are is because they have dedicated a lot of their time helping veterans and transitioning military members learn about the VA loan through a skill bridge program called Allegiant Vets. And that's something that I went through. And that's how I ended up meeting Marcus, and the value that he's bringing to the VA community is not the VA community, the value that he's bringing to the veteran community through VA education on loans is just super valuable. It's super valuable to us. It's answering a lot of questions. It's making people more educated, and he's dedicating a lot of his time every week to our community. So please, if you can, I have the links for Jonathan and Marcus down below in the video. So go down there, schedule some time to talk to them about your current situation. If you want to do the interest rate reduction refinance loan or streamline loan, give them a call. Talk to them, see if that makes sense for you and your family. If it makes that financial sense, like we were talking about, because we should give them our business because they're dedicating so much time to helping us. Because that's definitely something they don't have to do, is dedicate all that time every week. So let's help them help us. You know what I mean? So
yeah.
I really appreciate the time and effort that you put in to helping our community, Jonathan. Thanks, man.
Absolutely. It's a lot of fun for us. We get to talk to people from all over the world and, get to constantly have, new scenarios. I mean, or working with, civilians, kind of the same thing all the time for the most part, but we get a lot of unique, challenging scenarios with the VA, with people moving back into the United States from overseas and just getting new orders and getting transferred to a different duty station. And so, it's a lot of fun, and we appreciate you guys and enjoy working with everybody.
And if you want to just cover the things that they might find in the links below, it's scheduler. Then you can also, like we talked about earlier, like the window as far as the 0.5% lookout, things like that.
Yeah. So there's 2 links. One of them is just a calendar link to Marcus and I. So it pretty much looks through our calendars, and just you can select a time, and it'll go to whichever one of us has availability. So that's for if you guys are want to talk about anything related to a VA loan. So if you're looking at purchasing in the next year and you want to get some questions ironed out and figure out, what's the plan I need to be on, whether it be credit repair or how much money you're going to need, or, you just want to go over like, hey, what would my payment look like right now based on where I'm going to move? Feel free to schedule an appointment with us. They're 30-minute blocks or 45-minute blocks, but I mean, we go over all the time. So that's that link. And then the other link is the VA rate watch list. And that's for if you're already in a VA loan. That's the list that we check weekly, and I think Marcus sent out 30 text messages and emails last week for the people we had that were eligible, that were 0.5% lower now than where they were at. And I think that's going to ramp up to, 50 or 100 people a week. We're going to probably be texting and emailing here soon. We have like 300 or 400 people in there from between this and between, our Allegiant Vets affiliation with that Skill Bridge program, which, a lot of people are like high fives. So if we get into the low fives, that, that almost that entire list probably is going to be eligible to do the VA IRRRL. So it'll get pretty busy, but we won't spam you.
5%, right? High 5%, not high five.
Yeah, high 5%. Yes. Yeah. So like I said, we're not going to bug you or spam you. We don't sell that information. Marcus and I are the only ones that look at it, and we just basically sort that list in our CRM every week, and it tells us, we put in there, hey, okay, the rate's at 5.6. So we sort in there anybody that said they were above a 5.6, and we just notify you and say, hey, if you want to book an appointment to discuss and for us to calculate your exact savings, then please reach out to us and let us know.
All right. Yeah. So go down in the link below, whether you want to do one or the other, get to talking to Marcus and Jonathan and get your real estate investing or just buying a new home under wraps.
Just saving money. Yeah.
They're just saving money. There you go. Just saving money. So go do that and talk to Marcus and Jonathan. With that, thanks for watching, and we'll see you in the next video.
Thanks, guys.